This is Gabriel Shahin, president of Falcon Wealth Planning. I'm here with Managing Partner Michael Jensen. We're here to talk about the Q1 Falcon flyover, and we're here to talk about a handful of things that happened so far for the first quarter of the year. And also we're going to discuss the volatile April that we've had. But Michael, thanks again for joining.
Yeah, thanks for having me. We had a big change up from the prior quarter, some new trends emerge, and then we'll get into the April tariff talks as well.
So kind of the first part is starting off here, as you can see with the slides coming up. You're looking at kind of the first three elements. The first part is U.S. markets have pulled back, and you've seen that. But international has actually done very, very well. So yet again, this is the importance you see in diversification, which is why it's crucial, right? When you see a minus 10 to 20% on U.S., but then international is up double digits, majority of the portfolios are not down nearly as much as the markets.
Yep, fixed income was a big kicker as well. So the return of diversification, it has now become cool again.
So going into that, you are seeing now through inflation, slowing economy allows for that Fed rate cut for the second half. So you are going to start to see a bit of a slowdown. And when you are looking at the difference between this year for the start of the year versus last year, you can see last year was booming. When you look at up 25% and down 5% for the S&P 500, and the same for small caps and so on. So you could just see it all throughout from large caps, international, and bonds.
Yeah, and if you remember, 23 was really a continuation into 24, so 25 marks a big change here, especially looking at international small caps. Again, that's highlighting the U.S. markets as well. So fixed income and then alternatives, which we'll touch on later.
Now, when you look at the Magnificent Seven, right, some of these biggest companies that are out there, historically, it like returns 70% of the market because it's just so strong. And you're seeing almost a reversal when you look for the past 2 years of 2023 and 2024, where the Magnificent Seven were up 270%, and you have over the rest of the 493 of the S&P 500 that only had 40% returns. You're seeing that completely reversed, where you're looking at about 15% down versus virtually flat. So it's 15 times worse versus historically you're looking at about 8 times outperformance. So this is why diversification is key. In hindsight, sure, it's fantastic to be in the Magnificent Seven, but at the same time, you win a lot, you lose a lot, and most people don't like that roller coaster.
Yep, this is the proverbial monkey throwing darts at the board. It was hard to miss. You pick one of the names, you're up double digits there. But now, especially with some of the big headline news events, in Q1, that was the China DeepSeek, and now with the tariff talk measuring exposure. The thing is, when you're not diversified, you realize even though there's 7 different companies, a lot of them have some of that same key drivers ahead that led you up, now that are leading you lower.
Let's continue the conversation with volatility. Now, keep in mind, this chart is from Q1. Folks, we've seen a lot of volatility here in April. We've seen now, 10% swings a few different times and a couple on the way up. So yes, this is not uncharted waters, but volatility has really kicked in now here starting of Q2.
Yeah, April's made history. You've heard, hey, biggest day on the way up, biggest day on the way down. So we've had a bunch of headliner days. A lot of it is tied to the macroeconomic realignment of trade. So yes, April has been quite the stark change from Q1.
And keep in mind, when they say the biggest, well, that's because the market's already higher. So 2,000 to 3,000 point move is maybe like a 10% move. Where if I remember, I was only a few years old. On Black Monday, it was like a 23% drop in that one day. Continuing the conversation, just U.S. economy expected to slow down. But for just a couple comments on your end.
Yeah, and this is a big result of what we've seen with the tariffs. And we're right in the heart of earnings seasons as we record this. Very positive news coming out from a lot of the leading companies reaffirming past guidance with how they're guiding for the rest of the year. So that is very strong to see, but a lot of commentators out there of, hey, maybe summertime we'll start to see really some inventory and shortages as a result of the trade war, especially highlighting China, with you're seeing shipping cargoes down about 60% across. So we're in the midst of the trade negotiations, so all eyes are turned now on what are the longer term ramifications as this leads to a potential slowdown and even the big R word of a recession, about 60% now with some of the market indicators.
Yeah, and you see a lot of this too with concerns of the labor markets. Say what you want, even though it's slowly increasing, you still have a very strong labor market, as you can see in this chart.
I would say that's key because most recessions are led by labor issues, and that has been another one of the bright spots there is we have a very tight labor market, and we see no signs of that slowing down.
And you just see it in general, as you see in the next slide. You're just talking about inflation. You see we're really starting to peak out in 2022, where you still have inflation hovering almost at 3%. And the government's goal is to have roughly a 2% inflation, but you're kind of seeing still some stability here, but does, as it says, remains persistent.
Yeah, and whether it's eggs, whether it's gas, everything's kind of taking the charge there. How will inflation, are retailers like Amazon's of the world able to pass along prices yet again? But let's remember here, we're looking at the 2020 period, CEOs, companies, even consumers, they develop resiliency, they developed habits from prior years of spike inflation. So it wouldn't surprise me if we think we're a little bit more resilient than we give ourselves credit for.
Yeah, totally. I mean, you can continue the conversation with just policy and uncertainty and so on.
Yep, and we're expecting some of those first kind of dominoes to fall down. The administration is kind of touting some advanced trade talks, and the big one really is focusing on China, but we think it all starts here with some of the realignment that we've seen with global trade, some of the big emerging trading partners with the US, looking at Japan, looking at India. Those are big ones in the focus, but everything there is going to have a domino effect. One of the things here people have really forgotten about is some of the trade cuts that are coming and how that might be a good way to help stabilize and stimulate GDP moving forward.
And so when you look ahead, you're looking at remaining invested in equities. This isn't the time to freak out and sell, right? And so remaining invested is going to be crucial. Staying flexible also on fixed income is important. And then, of course, just embracing new ways for diversification. Even a firm like us is now looking heavily into more alternatives. As you can see, there's been so much benefits coming from private markets, which makes sense when you look at just the stock market going from 7,000 stocks 20 years ago now to 3,500 stocks, 20 years later, and where we are now. Private markets is becoming more important in that regard. But I mean, let's talk more about the volatility and staying course. Love your input again.
Yeah, it's always fun to look at different periods of time. The COVID crisis is kind of the most recent one we all think of. The financial crisis was probably the biggest one in our investor minds there. But really looking at staying the course 1 year later returns. That's always a surprising number when I look at through sampling the different time periods here. So, yep, staying the course within equities, but I still think very important. Now it's a time to peek under the hood. How have you been invested? And what we've really seen with a lot of clients coming in the doors is they were shocked how much exposure they had to some of these growth names, the Magnificent Seven, and it's not a problem until it is. And when you see everything in your portfolio trading in lockstep, especially when you get a big red down day, that's the time now to really focus in and say, hey, do I have the right balance, even within U.S. stocks? Do I have enough value? Do I have enough areas of the portfolio?
And I love just looking at 1 year later, how the portfolio, what the performance looks like after a massive drop in the market. And you've seen that in the next 12 months later, same thing. So I just always think that's important as you look at these certain times, whether you're looking at Black Monday that I mentioned earlier, to the financial crisis of 2008, to the COVID crash, and now here. So there's always different aspects that you just want to look at to hold the course and to stay disciplined. And I love this chart, right? We talk about this all the time. So many different reasons and things happening, but the chart goes up. People and humans are resilient. Companies are resilient. They will find a way to stay in business and make money. At the end of the day, there's no surprise here. And this is what I love. And you, I think, communicate this very well, Michael. Take it from here.
Yeah, it only takes a few days to really make a long-term impact there. So with time in the market, you always got to be right twice of when to get out, but when to get back in. And the best days of the market always follow the worst days there. So instead of looking to time it, let's really think, put on our financial planning hat and look, hey, where am I going to need those distributions for this rocky period? Can I be able to pull from bonds? What part of the portfolio allows me to ride out this storm? Because as we've seen with that chart, up and to the right, the better days are not if, but when.
When you take a look, just recent sentiment, just how people are feeling right now, it feels a bit unique and skewed. You got political reasons, you got the market dropping, you're hearing all this concern of tariffs and so on. So yes, this does make time for us to feel we're unsettled and we don't feel great about what's happening in the markets. With that being said, you take a look here on just what the charts are looking like, and just even with the top 10 bearish periods, and you look just 1 year later what those returns look like, yet again, it's ignoring the noise, staying on pace, being disciplined. This is where we feel sometimes we're more of a financial psychologist than a financial planner.
And I think always there, we got to go back and take the page out of Warren Buffett's book. When others are fearful, that's when you look to be greedy. But it's easy to be that investor when everyone's winning there and being greedy, and that's the time really to reevaluate.
I love this input here just on U.S. large caps and profitability. I think this is cool because this is very important for us. It's so easy to choose a large cap fund. It's very efficient, especially when we're talking about the Magnificent Seven carrying the weight on large cap. When you start looking at mid caps and small caps and international, this is where you have to be a bit more mindful. So for us, we like having tilts in profitability. So here you can see on the unprofitable companies versus the profitable companies, and just focusing on large cap, you can bring it home.
Yeah, and I think that's been a big kind of evolution of, hey, we are fans of low-cost, tax-efficient index investing, but it doesn't have to stop there, especially when you get periods of looking at the S&P and it getting so overweight, so overbought from the growth side. How can we layer on some of this smart, disciplined investing to look to rebalance into more of that value camp, that profitability? Because when you do get rocky times, it's the companies that have those disciplined balance sheets, that have lower levels of debt, that are able to ride out those waves and to redeploy capital and actually take advantage of periods when there is market sell-offs.
Taking a look at real yield, right? So when you take a look at just what's going on in the markets, what type of input do you have on something like this?
Yeah, hey, it's been, let's say, a pretty boring spot for bonds the last couple of years. So when we look at what's out there now, where you have real yields, which means what you're able to earn on top of the baseline inflation, it is starting to be a pretty attractive environment there, especially when you get periods of volatility in the stock markets. That's what's going to help buoy you. So you look across a lot of the fixed income specialists. I know we just had the chance to hear from the PIMCO CIO, and one of those points was pointing to that real yields is actually they're projecting for periods of outperformance over the next 2 years in the fixed income market. It's just where you're looking.
Yeah, just always something going on, always something to discuss. And this is yet again why it's important to stay diversified. As you can see with the chart over here, this is when you take a look at what's happening with stocks versus bonds, when you take a look during the dot-com bubble, the 2008 global crisis, and during COVID, and even more recently, it's relevant. And this is diversification, and it's key. And there was times of uncorrelation during 2022, but you have to stay disciplined on what's the most logical approach. It's not always going to be a situation where you have double-digit inflation and increases in interest rates. So by staying true, I think that's going to be huge. Going into kind of, you can continue the conversation. So Zig and Zag, you wanted to talk about this one.
Just reminding me, diversification, it's often called the only free lunch within investing, really taking that to heart. And what we had seen there with kind of some of the people, even in instances giving up on fixed income, giving up on international, it was the breakdown of it being correlated to the downside. We kind of got that reprieve here in Q1 there of bonds really standing up when stocks started to falter, and then also looking at international, and a lot of that on the international side just had to do with valuations had to come back to earth. The U.S. market was trading at kind of historically rich valuations when the international markets had almost been forgot of in some instances.
And then, of course, you have alternatives kind of going into this. You're taking a look at, of course, what cash is doing, obviously what the U.S. stock is doing. Then you look at multi-strategy. Then even gold has had a resurgence. And this is yet again, this isn't the time. I've actually had clients say, maybe I should sell stock while it's low and buy gold while it's high. This is where, yet again, as a financial psychologist / planner, we have to pump the brakes and say diversification makes sense. And it truly does, and this is an example of that. And I think when you look at all the different alternatives that it's out there, This is why it's crucial to stay diversified and stay true. Yes, you've seen certain investments do 10, 20, 30%, but you also have seen some lose 50, 60, 70%. So staying diversified is huge, which is why you see in this next slide, it's sometimes instead of winning more, sometimes how to win more is just by losing less. We talk about that quite often.
Yep, and when you do the math there, when you're down 50%, it takes 100% to get back to even there. So often what's referred to as variance strain. So really looking to how can we shore up the portfolios on when you're drawing down.
Kind of bring it all together here. So don't lose out over the long run. Stay disciplined. I know you've kind of already seen that rebound in the second half of April already. I think U.S. growth to remain slow, but we still feel positive, especially with a bunch of things happening in the background through our government. We don't know what's going to happen with tariffs. We don't know what's going to happen with the interest rates. We don't know what's going to happen with a lot of things through political relations. But what we do know is businesses and economies, especially in the U.S. through capitalism, they don't fail. They hit speed bumps, but they don't crash. And of course, that's the thing with the heightened policy uncertainty. So these are the things that we are consistently looking at. This is why you've seen portfolio changes in your portfolio. And this is why we want to bring Michael Jensen here for the Falcon flyover here for quarter one.
Yep, appreciate you having me, and always a good reminder of periods like this. We can always kind of really pour into the investments in the portfolio, but also a good reminder of there's things to be done. Just because you're sitting on your hands staying invested, that doesn't mean that there's not financial planning opportunities, whether you're making an IRA contribution, doing a Roth conversion, qualified charitable distribution, the list goes on and on. There are ways where you can be proactive, and it doesn't mean looking to get in and out of the market. It's keeping that long-term perspective and looking at it from that tax lens as well.
Always great having you. Hopefully you guys enjoyed the Falcon flyover for 2025 quarter one. We look forward to serving you.